Hello again and welcome back. Today we're going to discuss complications in some of the common operating expenses of a business. Let's begin by reviewing an income statement. This income statement is prepared in what is sometimes referred to as a multiple-step format. The income statement is always for a period of time. It's for the year ending 12/31/X1. Now, one of the things that distinguishes a multiple-step formatted income statement is that we will come up with various subtotals of amounts leading to net income. It is perfectly okay to prepare an income statement where you simply identify all of the revenues less all of the expenses equals net income. But in this particular format, we actually create some subtotals that may have some additional meaning and value as we review and try to understand a company's business. The first item on the income statement is sales revenues. This is the gross sales revenues. There may be some contra revenues associated with those sales revenues, such as sales discounts or some sales returns and allowances. If we take our gross sales revenues and deduct from it sales discounts or sales returns and allowances, it yields for us a subtotal referred to as net sales revenues. Again, this is an important business term. It's a defined term. If we take net sales revenues and deduct from it one kind of expense or cost of doing business, the cost of the goods sold specifically and solely, it generates for us, again, a subtotal of profitability referred to as the gross margin. Another way to refer to gross margin is the gross profit or the markup on the cost in terms of determining our sales price. If we take gross margin and then deduct the various other operating expenses of a business, you see, most businesses have more costs than just the cost of their inventory. If you're a grocery store, for example, yes, you do have various cost of operations reflecting the cost of your inventory as it's sold. But you also have costs for other aspects of the operations. For example, the building, and you might be having to pay rent or some other kinds of costs like property taxes or salaries and wages to employees that are handling the stocking of the shelves and the checking out of the customers. Operating expenses are sometimes referred to as selling and administrative expenses. In fact, if you think about the various costs of a business, you do have theoretically the cost of the goods that you sell, and then all of the other costs of the business are costs incurred in trying to sell that product or simply administer the business. The cost of the building is really a cost associated with providing a place that your customers can come to and buy the product. The cost of the building for some grocery store is really a cost of trying to sell your product, as would be the utility costs that are utilized in the operation of that building. I mean, you can't sell your product unless you have a building to sell it from. And so these various different kinds of operating expenses, above and beyond the cost of inventory, might otherwise be referred to as selling and administrative expenses. And many times they include some items like salaries expense, something referred to as payroll tax expense, which we'll be discussing in a few minutes, utility expenses, property tax expenses, maybe rent expenses and advertising expense, various other costs of doing business. If you take your gross margin and deduct all of the various operating expenses, it yields a subtotal referred to as operating income. Now, it is possible that businesses might have other sources of revenues and other kinds of expenses that really aren't part of their normal operations. For example, let's say that I have a large building, I'm operating a grocery store, but I've got some extra space in the back of the store, and I've got a friend and he's an accountant, he just needs a place to kind of set up an office or something, and so I rent some space to him. Now, I might generate, as a result of this, some rental income or rent revenues, but I'm not in the business of renting space. I'm in the business of buying and selling grocery products. And so rent revenue is really not part of my normal operations. It's just kind of a supplemental source of income. Those kinds of supplemental types of revenues and expenses are typically designated separately below operating income. One of the common operating or other revenues might be interest revenue. If I'm making a loan to an employee and they pay some interest on that, hey, I'm not in the business of making loans. I mean, banks do that. And yes, a bank's major source of revenue would be interest revenue on loans that they make. That's in their normal operations. But if I make some loans just on an investment basis, yet I'm a grocery store, these certainly aren't in the normal course of my business, and they would be reflected as supplemental revenues or other revenues and expenses. In many cases, one of the more significant expenses that businesses have is sometimes reflected in this section of other revenues and expenses, and that is interest expense. You see, in order to capitalize a business, get the resources necessary to operate, many times we'll borrow funds from banks or the public or from various other sources. And so it is very common that businesses will have a large interest expense. You might be justified in reflecting this interest expense as one of the business's operating expenses. I mean, you can't really operate a business unless you have capital or resources or assets, and one of the most basic ways to get that is to borrow those assets or resources and incur the associated cost, which is the interest on those borrowed resources. Well, in my opinion, interest is a very, very common expense because many businesses are capitalized with debt. However, traditionally, you will see interest expense reflected separately from operating expenses down here in the section referred to as other revenues and expenses. I suppose the explanation and rationale for that is that this interest expense is typically not a cost of operating the business, it's a cost of financing the business. And we want to distinguish and separate that out, so that those looking at this income statement and evaluating it recognize the cost of operations versus the cost of financing a business. If we take our operating income, again, operating income is the gross margin less all the various operating expenses. If we take our operating income and add any of these other supplemental revenues and deduct any other expenses, we would come up with a number referred to as income before income taxes. Again, some of you will say, well, why are you designating income tax expense separately here near the bottom of this income statement? Isn't income tax an expense that's incurred in the normal operations of a business? And the fact of the matter is that makes perfect sense to me. I mean, income tax expense is a cost of doing business. However, many businesses like to reflect the income tax expense as a separate line item on the income statement. The purpose is, here's how much we're making in terms of profitability before the government gets their hand in our pocket. I mean, look at how profitable we would be if, in fact, the government were taking so much of our money. Or maybe they're simply saying, look at how generous we are as a business making these contributions to the financing of our federal government. But anyways, most businesses will distinguish separately the amount of income tax expense. If we take the income before income tax and deduct the income tax expense, I guess we would finally end up with net income or loss. Again, according to generally accepted accounting principles, after we have our net income and loss, it's also necessary that we reflect that net income or loss in terms of earnings per share. One of the most common operating expenses is the cost of employee salaries and wages. To date, in our examples, we've simplified this accounting for salaries and wages. For example, we've accounted for the payment of an employee's wage of $1,000 by simply reflecting a credit to cash and a debit to wage expense. Unfortunately, the true accounting for salaries and wages is much more complicated than just a credit to cash and a debit to wage expense. The major complicating factor in the accounting for wages and salaries is payroll taxes. There are two kinds of payroll taxes that must be considered and accounted for in all businesses that have employees. One is the employee payroll tax withholding. The other is a separate tax on employers referred to as employers' payroll taxes. Let's begin this discussion of payroll taxes by first considering employee payroll tax withholdings. Now, this is something that most of you are probably pretty doggone familiar with. You know what I'm talking about. You get a job. If you generate income as an employee, you, the employee, are responsible for certain taxes. One of those taxes is referred to as FICA or FICA taxes. This is federal Social Security and Medicare. In addition, you'll have to pay some federal income taxes. Most states also require that an individual, in this case an employee, pay some state income taxes. Now, there are some states that do not have any state income taxes, and so this wouldn't be a problem in those particular states. But many, if not most of the states do have some state income tax that is to be paid as a result of salaries or wages earned by employees. In some cases, you also may see withholdings from your paycheck for union dues if you belong to a union, or you may even direct your employer to withhold from your check some contributions that you would like to make to some retirement or investment plan. In fact, recently I decided that I wanted to make some charitable contributions to the United Way, and I authorized my employer to withhold from my check some of these charitable contributions. So we can direct, or may be required in some cases by federal or state law, to actually have certain amounts withheld from our salary. Now, the accounting for this is important. Let me ask you this question. Whose taxes are these? I mean, the withholdings from your paycheck. Is that your tax or is it a tax on the employer? The answer is those are your taxes. The employer is merely acting as an agent for the government entities, directing theoretically what is and should be your money as payment of your taxes to the federal and state governments, etc. So really, these are not the taxes of the employer. They're your taxes. Now let's look at an example of how we would account for this. Let's assume an employee's gross wage for the month is $1,000. However, the employer withholds $70 of FICA taxes, $170 of federal income taxes, and $60 of state income taxes before issuing a check to the employee for the net pay of $700. Well, what journal entry would we make in this case? The journal entry would be a debit to wage expense for $1,000, even though the employer is only cutting a check to the employee for $700. We'd have a debit to wage expense for $1,000 and a credit to cash or wages or salary payable to the employee. This is the net amount that we're going to include on the check to our employee for $700. The difference, or $300, represent the employee's money, but we as an employer are going to retain those funds and pay it on behalf of you, the employee, to the appropriate federal and state governments. So the difference, this $300, this amount of withholdings, is not the employer's money here. The employer is still going to have to pay that out in addition to the $700 for you. The only question is, who do they pay it to and why? They are going to pay $70 to the federal government for your FICA taxes. It's your money, really. The federal government requires that they not give it to you and have you pay it yourself, but that the employer will pay it on your behalf. So that's really a payable to the federal government that we, the employer, are going to assume responsibility for. In addition, we may have some federal income tax that we're withholding from you and going to pay to the federal government directly on your behalf. We're also going to have to pay to a state government some state income taxes, your income taxes, and we'll pay that directly on your behalf to the government. The amount of wage expense is $1,000. Many people would think the cost of the business is only $700 because that's the amount of the net check actually paid to the employee. But when this transaction is all said and done, the employer will have paid out a full $1,000. They will have paid $700 to you and the remaining $300 to the federal and state governments on your behalf. The employer is out $1,000. And we refer to that as wage expense because all of that money theoretically is the employee's. I'm simply paying it to different places or recipients on the employee's behalf. Why does the state and federal government require an employer to withhold and pay directly these various amounts on behalf of the employee? Why not pay the employee the full $1,000 and let the employee pay their own FICA taxes and their own federal income tax and state income tax? What do you think? Well, some people have suggested that maybe the federal and state governments don't really trust us to pay our own taxes. If they gave us the money, the full $1,000, we'd be kind of hesitant to cut a check and give it back to the government. So instead of us actually getting that money, why don't we'll just never give it to the employee in the first place, and we'll make it legally required that the employer pay that. Some people have suggested that maybe the governments are doing this because they want to earn interest on our money. If we were to get our cash and hold on to it before paying our income taxes at the end of the year or something like that, we'd be earning interest on our own money before paying it to the government. Maybe the government wants to get it more quickly so that they can be earning interest on it rather than us, the employee. I suppose, there might be some explanation too, that the federal government needs money along the way during the year in order to pay the various bills of government. So it makes sense for them to collect the cash along the way. The second form of payroll tax is referred to as employer payroll taxes. The first one was the employee's payroll taxes. These are taxes that are the employee's cost or taxes to be paid to the government by the employer through withholding. An employer's payroll tax is a tax on employers for the simple privilege of having employees. The employer payroll tax is comprised of FICA taxes. This is Social Security and Medicare, and the amount that the employer pays is an amount equal to that of the employee. The total amount of FICA taxes collected by the federal government, half of it comes from employees and half of it comes from employers. So employers are also making a contribution to the Social Security program. In addition, there's something referred to as federal unemployment insurance. I like to call that FUI. There's also something referred to as state unemployment insurance. Now, there is some practical reasoning behind these various employer payroll taxes that ought to be considered. The fact of the matter is many people would suggest, and it seems rational to me, that employers should be making some contribution to a program that ultimately provides some retirement benefit to the employees. So for FICA and Medicare, for employers to pay something into that program may make some sense. In addition, federal unemployment insurance and state unemployment insurance are programs operated by the federal and state governments such that if an employee loses their job for at least a period of time, they will have some benefits through the federal and state programs to give them some source of income while they're in the process of trying to obtain a new job. Again, maybe that's an appropriate contribution for an employer to make a contribution to a program that actually funds unemployment insurance for laid off employees. The fact of the matter is that employers theoretically are incurring a legitimate cost here. we're going to be crediting cash, and we'll go over the journal entry here in just a moment, and debiting a payroll tax expense for the amount of these taxes. Theoretically, an employer would be just as well off to pay out these taxes, but to simply increase, instead of paying them to the government, simply increase the amount of the salary or wage to the employee. If we eliminated these taxes, theoretically, a business could simply pay more to their employees. Of course, some people would suggest, how likely is that? Will an employer actually do that? And in fact, these employees do need these various benefits. But you do need to know here that effectively what we're saying is that employers pay taxes for the privilege of having employees. How would we account for this employer payroll tax? Let's look at an example. For example, the employer is going to now record the employer's payroll tax liability arising from the $1,000 employee payroll that we discussed in the previous example. Assume that the FUI, Federal Unemployment Insurance, and State Unemployment Insurance, SUI, amount to $10 and $5 apiece, respectively, given the payroll of $1,000. In this case, the payroll tax expense would be accounted for as a debit to the expense. Payroll tax expense. This is a cost incurred for the privilege of being an employer. The credits are to cash as we pay them, or in this particular case, maybe we'll show it as employer's FICA payable, employer's FUI payable, and SUI payable, meaning that we're going to pay them in the near future. By the way, a question that often is raised is, how do we actually determine these amounts? And when does an employer actually have to remit payments of not only these withholdings, but these employer payroll taxes? The answer to that is that sometimes there are very, very specific rules issued by the federal and state governments as to how these taxes are to be calculated and when they're to be paid. In fact, I got on the phone this morning and discovered that if you want to know exactly how to calculate and actually get the forms in order to make these calculations, at least for FICA and federal income taxes, you would call the IRS, and they'd be happy to make those forms available to you. By the way, as far as federal income tax withholdings are concerned, it is really the employee that determines the amount of that federal income tax. You see, FICA taxes are determined based on a specific outlined rate, but federal income tax withholdings are actually determined by an employee, or at least the amount of it is, through the W-4 form. When you are hired by an employer, they will have you fill out a federal W-4 form in which you identify certain things called exemptions. Through some calculations, these exemptions are utilized to determine how much needs to be withheld from your pay in order to fulfill your potential or probable income tax obligation for the year. So as far as the employee's federal income tax withholding is concerned, to some extent you have some influence over that amount. That would also typically be true of your state insurance tax. These amounts can be easily determined given the various forms issued by the federal government through the IRS or the state governments, usually through some state tax commission. The other question is when does the employer actually have to remit this? Again, that information is provided on the forms and in many cases depends upon how large the amounts are. If we have a very large payroll, the government wants that money much more quickly. And so they'll set up a timetable. Maybe it's within the next week after the payment of a payroll or after a payroll or within a month or maybe within the next few days. And again, the timing of these payments changes and periodically and needs to be determined by asking the proper authorities and getting the proper forms to handle these kinds of payroll issues. In summary, I want to make these 2 points before we move on. Payroll taxes can be complicated. In fact, many companies will actually hire some kind of an outside firm to actually make these calculations, handle the disbursements of checks to employees, do all of the basic accounting for them, and file all of the appropriate forms. If you're going to be a small business person and plan to hire employees, you will take on some responsibilities for withholding certain amounts from your employees' checks and remitting them directly to the government, and also paying certain employer taxes yourself. Remember, there are two costs of being an employer. One cost is the gross salary and wage of your employee, even though you may only be remitting a net pay to the employee. You will ultimately pay the full amount of that salary and wage, if not to the employee, to the government on behalf of the employee. The second cost of having employees is the employer's payroll tax expense, which again is simply a charge or a cost for the privilege of having employees. Now let's review the solution to this first problem on salaries and wages and payroll tax complications associated with the payment of those salaries and wages. In this problem, you have been given the gross salary and wage for 3 employees. Plus, you've been given various rates of withholding. FICA employee FICA tax withholding, the rate is reflected. Then also for the federal income tax, and again, that's a different rate for the different employees based upon how they completed their W-4 form, which is usually a reflection with higher rates for those employees with higher salaries and wage rates. And then finally, the state income tax has also been provided to you. If we use simply this information, as long as we're doing well in our math, we can calculate the total amount of FICA that will be withheld from the employee's payroll checks, including the total federal income tax and state income tax. The total FICA withholding is $359.55. That's a withholding from the total gross salary and wage of $4,700. The federal income tax withholding on all 3 of these employees combined is $805, with the state income tax withholding at $275. Okay, how are we going to reflect this particular payroll? And again, the way the problem is described, this is a payroll, I believe, for December, and isn't actually going to be paid until January to the employees, but we do need to reflect it as a cost of operations in December. If it's a salary or wage associated with the employee's work during December. So we're going to need to reflect salary and wage expense here, even though we're not going to remit any cash until January in the next period. The total amount of salary and wage expense is the gross salary and wage. The employer is going to be remitting a total amount of cash relative to this payroll for the employees of the gross salary and wage of $4,700. That is going to be the cost of the wage. We'll reflect wage expense with a debit of $4,700. The only other question here is, who are we going to pay those wages to? $3,260.45 will be paid directly to the employees in the payroll check. We'll refer to that as wage payable or net wage payable to the employees or something like that. The other withholdings are really the employees' funds, but we're going to pay them to the government on behalf of the employees. So we have employee FICA payable to the federal government of a total of $359.55. The employee federal income tax withholding to be paid to the federal government on behalf of the employees is $805. And then the state income tax is going to be payable to the state government on behalf of the employees is $275. That is the entry to record this payroll for the month of December, even though we're not going to remit the cash until January. When we do remit the cash, we'll simply credit cash and debit these various payables. We won't call it an expense again because we've already called it an expense in December. which is the appropriate period under the matching principle because that's when the employees actually work for us and provide a benefit to the business. The second payroll tax that needs to be accounted for is the employer payroll tax. The employer is obligated to pay an equal amount of FICA taxes as the employee pays. Plus, they must pay federal unemployment insurance, and again, a rate is provided here, and therefore a calculation can be made as to how much that total would be, along with state unemployment insurance. The entry to record the employer's payroll tax expense, the cost for the privilege of being an employer, is to debit the expense, payroll tax expense or employer payroll tax expense, for the full amount of the FICA, FUI, and SUI, or in this particular case, $594.55. Again, the credit would be to cash if we were paying it now, but we're not. We're going to be paying it, in the near future, so we're going to reflect payables. To who? Well, payable for the employer FICA taxes payable to the federal government, and for the FUI and the SUI payable to the federal and state governments respectively, in the amounts reflected here of $359.55, $94 for the FUI, and $141 for the state unemployment insurance. Again, when these various obligations are paid, usually, or in this case, probably in the month of January, we'll simply credit cash and debit these payables. But the expense has been properly recorded in the month of December, because these employer payroll tax expenses here are associated with the payroll of employees working in December. So we're matching it to the proper period. In accounting for other common operating expenses of a business, the key principle to consider is the expenses recognition principle. You'll remember the expenses recognition principle has to do with the timing of expenses and seeks to record or reflect expenses in the period in which those costs of doing business actually contribute to the production of revenues, when in fact they provide some benefit to the business, not necessarily when those costs are actually paid in cash. Examples of the expenses recognition principle in action in the accounting for common operating expenses can be seen in the following three examples that we'll look at. For example, assume property taxes amounting to $3,600 are actually prepaid on, for example, November the 1st in the year X1, and those property taxes really represent property taxes paid in advance and therefore covers our tax obligation for the next 12 months or through the period ending October 31st in the year X2. In this case, the original transaction representing the payment of these property taxes, prepayment, would be on November the 1st, X1, to actually credit cash for $3,600 and debit not an expense, but to debit prepaid property tax, prepaid property tax expense, which is not an expense at all. If it's prepaid, it actually has probable future benefit. The probable future benefit relative to the prepayment of this property tax is that we have now the right, and again, assets are property or rights, but we have the right now to own, possess, and operate our property without the government's intrusion for the next year. This is actually a legitimate asset called prepaid property tax or tax expense. Even though it's got that word expense in there, you'll remember that it's not an expense at all. It's actually an asset. However, as time passes, the right to this future benefit is diminished or expires, such that if we're going to provide an accurate accounting for our assets and costs of doing business or expenses in the proper period, and in fact our accounting period ends 2 months later on December 31st, we will need to make an adjusting entry to show not only the reduction or using up of this right to the future benefit of the prepaid property taxes, but also the cost of those property taxes associated with the months of operations that tax period includes. The period in which we've gotten benefit here is for the month of November and December. 2 months worth. The property tax at $3,600, which is $300 a month given a 12-month period, would mean that we've really realized the benefit of this prepayment of property taxes for the month of November and December, or 2 months, or $600 worth of the cost of this property tax should be reflected as a cost of doing business in this year X1. It's the period in which we had the benefit. So we'll debit property tax expense in an adjusting entry for 2 months worth, or $600, and credit prepaid property tax expense. Again, my reason for bringing this up is that, again, we're trying to account for common operating expenses. Property taxes are a common cost of operating a business, and in many cases, they're prepaid. The accounting is to make sure under the expenses recognition principle that, in fact, we've recognized the amount of expense associated with the period in which we got benefit. Another example of these kinds of operating expenses might be in the following. Let's assume that we actually haven't received a utility bill for the month of December, and therefore we aren't quite sure exactly what our utility cost is for the month of December. However, we do need to reflect some expense for utilities in December. We just haven't gotten the billing yet. However, last month's billing was about $1,500 when we got it from the power company or the utility company. And so based on the previous month's billings, maybe we can estimate or anticipate that even though we haven't gotten a bill yet here in December, or even on the last day, we haven't gotten a bill yet from the power company, that since last month's was $1,500, maybe this month's might also be about $1,500. If, in fact, at 12/31/X1 we have not received any bill, and we haven't recorded anything as a result of not having received the bill, will I need to make some kind of an adjusting entry for the fact that I will receive a bill for December, I just haven't gotten it yet, and I'll be paying for it in the future? The answer is yes. The reason is the expenses recognition principle. Any cost incurred in a current period, like December, and it's going to be utility costs, must be reflected as an expense in that period, if that's when it gave us benefit. The problem in this case is we don't know exactly what that cost is. Now, theoretically, some businesses will actually wait until maybe like a week or two into the next year or period before they actually close their books for the last year, making any appropriate adjusting entries and then preparing their financial statements. So theoretically, we could wait until we get the bill and then go back and make the adjusting entry before closing the books for the prior year. We could do that. But in many cases, businesses now are trying to close their books as quickly as possible to produce really timely financial statements. In that case, what are we to do? The answer is that we would probably go ahead and try and estimate that utility bill and what the cost would be. If in fact we have reason to believe that it will be about the same as last month, which was $1,500, it would be totally appropriate and probably actually necessary under the matching principle to debit utilities expense for $1,500 and credit utilities payable. Now, when in fact January rolls around and we pay this utility cost, if in fact it's a little more, a little less than that $1,500, we'll adjust for this error in estimation in that future period. We won't go back and change the financial statements. So what I'm saying is under the expenses recognition principle, not only will certain operating expenses like property taxes need to be timed in the proper period, but when they're prepaid, but in some cases, we will need to estimate or anticipate expenses incurred in the current period, even though they will be payable in the future. And they would have to be recorded through some kind of an adjusting entry. Another example of an operating cost that needs to be reflected might be the payment of December's rent amounting to $1,000, in which we actually get the bill in December and pay for it on December 31st. Assuming this obligation had not been previously recorded, we haven't recorded anywhere previously that we owe this $1,000 of rent in December. If we get this bill and we pay it in December, we're going to simply credit cash and debit rent expense. And this is simple. We've been making these entries, for some time now. The point in all of this is to simply point out that most of our operating expenses are dealing with the issue of timing, the matching principle, to make sure that we're reflecting the proper expense in the period covered by the financial statements, regardless of whether we prepaid these expenses or whether we're going to pay for these expenses in the near future or whether we're paying for them currently. We need to identify that amount that represents a cost of doing business in this period of operations and reflect it as an operating expense in this period. And we've just looked at 3 examples of different timings of payment and how we would accomplish this accounting for the expense in the proper period.